Well, thanks for tuning in to this broadcast, and we are talking to the team at Motilal Oswal on their monthly note, Alpha Strategist. And it'll be interesting to figure out what is it that my guests today have to say with regards to, well, not just particularly this month's note, of course, and which is of course an interesting one, because every month they build on to what they have written in the previous months, and this month's note is titled Game of Thrones. The question only is, are the people who are sitting at the thrones changing quite quickly, or is it a slow, gradual process? Let me get in Sandipan Roy, CIO, Motilal Oswal Private Wealth, and Nitin Shanbhag, Senior VP, Head of Investment Products at the firm, to talk about this. Gentlemen, both of you, thanks so much for taking the time out and being with us. And curious title, Nitin, why Game of Thrones?
Let me start with Game of Thrones, obviously, because it has been a very interesting election, and that's where I think the title came to our mind. But it also symbolizes the fact that there will be a kind of shifts in the sectors that we see are the leaders. There would be some bit of sector rotations, etc., and in terms of strategies as well. But more importantly, let me also emphasize the fact that the Alpha Strategist has almost been prophetic over these last 6 months. We started the year by saying it's a year of all-rounder, and that all the asset classes will have their time under the sun at a different points of time, and it is the year where you have to stick to your asset allocation. We moved on to saying shifting tides. I remember we discussing that. Where we said that obviously there is some bit of uncertainties building up, given the election, given the geopolitical tensions, and given the shifting tides in the central bank stances all over the world, and the Fed's uncertainties, which then moved on to going through the maze, and now the Game of Thrones. I think the winners will keep on shifting, while the overall structural bull run continues. And that's what I think our Alpha Strategist is all about this time.
Okay, so Nitin, come in. I mean, 2024, year of the all-rounder, Game of Thrones, post-elections. Looking at the current valuations and levels, is it a good time to maintain the equity component, or would you swap that a little bit in the overall basket?
Right. So good question. So here's what we are saying. If you look at the entire equity space and you split it across market capitalizations, large caps continue to remain fairly valued, right? And this is against their long-term average of the last 10 years or so. They currently trade at very, very similar valuations to their long-term averages. It's the mid-cap and small-cap space which are trading much, much higher than their long-term averages. And that is where we see a little bit of a froth, and we have continued to sort of maintain our stance that there should be some correction in valuations going forward in this particular space. So as of now, as we had discussed last time as well, Neeraj, that we continue to be more biased towards multi-cap and large cap strategies as we speak. Having said that, we are saying that it's better to invest any incremental allocation in equities in a staggered manner. So large cap and multi-cap, stagger it over the next 3 to 6 months. And in mid-cap and small caps, you stagger it over the next 6 to 12 months. There is no case, though, in the market right now where you are actually trying to take money out of equities. So that's the answer to your question, that we are adopting a more staggered approach, but we are certainly not reducing allocation to equities.
Got it. Okay. Now, your study also suggests that mid-cap and small caps have witnessed higher corrections, maybe during periods of turmoil. So the question is, do you foresee these corrections to double down in the coming year, even as you do not find a case to move out of equities per se?
Volatility will certainly increase, given that everything is priced to perfection. We let's say anticipate earnings growth of at least 15% over the next 2 years, right? And the valuations are also accordingly positioned at this moment. So when everything is priced to perfection, any kind of negative surprise, which we saw for one single day, on the election day results, obviously the market, came back to rationality after that. But the thing is, we saw that any kind of surprises will lead to some bit of very very sharp volatility in the market, and hence investors need to be prepped up for that, and they need to stick to their allocation strategies. This is not a time to be extremely adventurous, but rather stick to your first principles of investment.
We have about 7-8 minutes left, so I want to put in 3 questions here. A couple of them on equities and one of them on gold. Now on equities, within the construct that you've laid out, the difference of the last 4 or 5 days, if you will, I know you don't talk short term, but I'm just using this as an example, relative to what we've seen for a better part of the calendar, gentlemen, is that banks have just started to show a divergence vis-a-vis what the markets per se are doing, by and large. Now my question is, because of the valuation set at which banks are sitting at, do they provide, and because it's such a large bucket of weightage on the markets, do they provide a sector in which you would rotate into and maybe rotate out of some?
Yeah, so again, that is a very, very important sector that you've touched upon, Neeraj. And we believe that there could be some rotation. In fact, as we speak right now, the PSU banking space seems to be gathering more pace than the privates, right? But having said that, we believe the BFSI or the banking sector as a whole continues to present a tremendous opportunity. Obviously, given the fact that we are just in the start of the next business cycle, there's going to be plenty of capex happening over a period of time. The loan cycle has pretty much started just about now. So while there will be rotation, right now we see a little bit of a thrust on the PSU side of things, especially PSU banking. But I'm sure that the laggards, the key private banks, will also somewhere come to the fore, and this sector rotation will keep happening even within the same sector because cycles are getting fairly shorter.
Yeah. So on the private bank side, it will be more stock specific, but I think some of them have actually become value stocks. Never before has that happened. So without naming stocks, I can say that some of these private banking companies, at least from valuations perspective, have become pure value stocks, and hence, it becomes important that we have a relook at at these kinds of companies, because the growth has not stalled there. It has just that money has rotated out of these kind of companies to other places. They will come back for sure at some point.
When did we ever think in the last 15 years that we'll label private banking stocks as value stocks? But such other times. Well put, Sandipan. The other equity-linked question is, the assessment of corporate profitability, and all through the last so many months that we've spoken about how Indian markets have given 4 years of double-digit returns now, and corporate profitability is done well. If I'm not wrong, your assessment about corporate profitability is also steady. So if that is indeed the case, does it leave room for private capex to outpace what private capex has been in the preceding years, and are there investing implications around the same?
Some of the sectors that have come into the entire industrial space are very different to the kind of sectors that you had in the previous
cycle. Okay.
And that, I believe, is going to be the key difference going forward. I mean, we never had defense as a big sector. We never had semiconductors or electric vehicles, or renewables is the new thing that is coming. In fact, a lot of studies do tend to suggest that over the next 3 to 4 years, these new sectors could account for almost 1/3 of the incremental industrial capex that India will do incrementally, right? So we believe that this cycle is going to be vastly different to the kind of cycles that we've seen between 2003 to 2007.
Okay, and so in which case, keeping with the title of your report, Game of Thrones, which sub-segment within the capex-driven theme could emerge victorious if indeed the components of this theme are different versus the past?
The typical industrial space, will continue to do well, right? Which is capital goods, engineering. You're obviously seeing signs of all of that happening. Real estate is an important area which has really picked up over the last couple of years or so, and that really is household capex, right? We don't see any signs of that simmering down just yet. Beyond that, some of these sectors were already are included in the PLI segment. That continues to get an impetus because the government has already provided for the funding for that. So that capex is going to take on, that's already on board, and that could incrementally add to some of the earnings from this sector going forward.
My final question, and you guys have been bullish on gold all through, but the Fed rate cut delay, does that alter the bullish argument for gold? Hitherto, it is not quite really impacted. Can it in the future? What's the stance on gold?
No, actually, we continue to remain bullish on gold. It was, see, the Fed rate cuts are, while we may speculate when it will happen and to what extent it will happen, that it will happen is inevitable, right? So there is a certainty around it. 20 central banks globally have already cut rates. Fed obviously is looking at its own macro data points and will have to take a call after that. But gold is also being driven by a lot of geopolitical uncertainty that is there, right? And there, I think that is as a segment, central bank buying of gold to mitigate that risk is one of the key factors that has also played in our stance on giving a bull call on gold or a buy call on gold. I think eventual softening of rate cycle and on the fact that the central bank buying to continue in a highly uncertain world in terms of geopolitical risks is why we will continue to remain bullish on gold as a category at a time when supply has not been really going up while the demand has been holding on.
Okay. And lastly, is the other throne, if I can call it that way, which is fixed income. Now, I was reading this article which spoke about how June 28th might be the probable date. We might get $2 billion worth of flows on that day itself as per some asset managers. And while the Reserve Bank may come in and stabilize the currency and the rise in the rupee relative to what it usually has to do. But here's the question. It's a watershed moment of sorts. There are other indices to follow. For the next 10, 15, 20 days or 30 days or maybe 6 months, what's the stance on fixed income, gentlemen?
The 10-year has already rallied quite a bit ever since we gave our first call, which was in October 2023. Today it is trading slightly below 7%. We believe that it's still a good time to enter. We may not be as bullish as what we were maybe 3 to 6 months ago, but we still believe that yields could soften, if not immediately, but certainly over the course of the next 1 year, because the RBI certainly will not cut till such time that there is a definitive direction from the US Fed. And hence, what we suggest is playing the entire fixed income through more multi-asset allocation funds. There are plenty of strategies which involve fixed income, largely speaking, together with a smattering of gold and to some extent, maybe equity or even arbitrage. These are the strategies which could provide much better returns or much better risk reward with efficient taxation for investors rather than merely sticking to pure debt.
And also, if we believe that the capex cycle is reviving and the credit growth is getting kind of stalled by the deposit growth rate, then there is a strong case for credit, especially from the alternate asset category. There have been a lot of reports citing the rise of AIFs and private credit as a segment to fuel this capex demand that will come. And that, I think, is another area that will emerge as a very interesting opportunity for investors to look at on the credit side.
Okay, gentlemen, we'll leave it at that. Thanks so much for taking the time out and talking about the details of this wonderfully titled name, Game of Thrones. It's on cue. The House of Dragons, which is the prequel, has just re-emerged with its sequel. So it's opportune time to name the note as well as Game of Thrones. But gentlemen, thanks so much for talking to us today.
Thank you so much, Gabe.
All right, with that, we need to slip into a very quick break, but stay tuned to NDTV Profit for more news and updates.